Hey everybody, this is my first time live, so bear with me with some of these technical difficulties if there are any. Hopefully I am live and that you can see and hear me. If not, just let me know and I can hopefully fix that. So give me 1 second as I try to just get everything set up. And I think the lighting is okay. Are you guys able to hear me? So if you can hear me, just put it in the comments, or if you can't hear me, let me know. Otherwise, I will just go right ahead and get started with this. Give me a second. Okay. No problem. Can you hear me okay, Heather? Hopefully you can hear. So, yeah, so awesome, great. So my name is Jay. I am been a CPA for about 10 years now. I'm out in California. Kind of my background is I was working at a CPA firm, a mid-sized CPA firm, for about 7 years. And about 4 years ago, I had started my own practice, kind of to focus on smaller businesses because the ones I've worked with, you know, I kept hearing stories about my bosses and like, oh yeah, I was with them since they were, just working out of the garage, and then now they're, some successful company or with lots of employees. And the demographics and the groups that I was working with then, they were much larger, and so I wanted to kind of build my own client base and work with uh, smaller tax like people and businesses. And so yeah, had the practice for 4 years. We've grown. Got two other partners now. One of them was going to join me, but she was unable to. She's got a newborn, and the baby was a little bit needy when she was supposed to come over. So um, yeah, so like as I mentioned, I'm in California, so just want to point out, every state has its own nuances with taxes, and every state is kind of a free for all when it comes to state taxes. So just keep that in mind. I will try to be more general and focus kind of on the federal level, because that's kind of where everybody has that in common with federal taxes and how that affects everything. And then many states, they do kind of follow federal, and they just from there they either modify it, or they just have something completely different, or they just it's exactly the same. So in a lot of cases, a lot of the things we'll touch upon should be pretty consistent with the federal taxes, and not so state specific. So and lastly, so I don't think I'll get too technical with anything. If I do, feel free to comment for me to elaborate on it, on any of the topics. And I'll also, I welcome questions. I do. The time I have allocated to actually speaking shouldn't be very long. I just kind of figured everybody has their own questions and their own concerns. That I did leave a good amount of time for questions and answers. Also, because every single person's situation is going to be different, so I think that's kind of the best way to kind of address the whole thing, is kind of to tailor it to just certain questions that people may have. And so yeah, so feel free to put questions in there. I do see the comments, so I will make a note and try to keep that in mind as I go through everything. So yeah, so I browsed through the group, and it looked like a lot of people are kind of starting out, or they've got the business going for some time now. You know, when you first start a business, by default, you're a sole proprietor. So that just means, for tax purposes, you would report your business or your activity income on a Schedule C with your personal tax return. So with that, you report your revenues, your expenses, or your deductions on Schedule C, and then there's no other separate filings that you have for your business. And another entity type, which I see is really common with the group, and it is common just because of its simplicity, is a LLC. And so if you have an LLC or you form your own LLC, for federal taxes, it's actually treated the same way as a sole proprietor. Your profits and your losses get reported on your Schedule C on your personal tax return. So there is no separate federal tax filing for an LLC if it's just one owner. If there's more than one owner, though, you do have a requirement to file a partnership tax return. So, one of the questions that I get from clients a lot, and I see that that's kind of what's driven, you guys to have me, is just, I have a business, should I form a separate business entity? And the question really just is that it just depends, because sometimes just keeping things simple is just the way to go. With running a business, there's two sides of a business that I always point out to people. There's the fun side of it, which is the front end. And in your case, for you guys that are selling cookies, is baking the cookies, making the connections with your customers, hearing their stories, and then, providing the cookies for their event or just for their own consumption. But then the other side of it is the back end side, right? Like the business side, the administrative side, the side that why I have a job. And, it's not always the fun side of a business that people think about when they go into business. And sometimes it's overlooked and it can be overwhelming. So, I always do tell people, deciding to form a separate entity, sometimes it's good, sometimes it's bad. It really just depends on what you're willing to kind of work with in terms of the administrative side, if you want to outsource it. And other factors also include, like, the size of the business. If you're only selling $10,000 or $20,000 worth of cookies, forming a separate entity may not necessarily be necessary. But yeah, we can go into that a little bit later. But yeah, so like I was saying, with a LLC, you are, just taxed kind of as a sole proprietor. But the main advantage is it does provide you some legal protection when it comes down to, if somebody were to come and try to sue you for something, what are the assets that they can take? If you have a LLC, they can take the business, they can sue you to the extent that your business can afford to pay it, but they can't actually go after, like, the house that you live in or your car or anything like that. So, the other thing to consider is, if you're worried about liability, is, whether or not you should get insurance. I think insurance is a good, safe bet for because it really only takes one time for it to really be worthwhile. Even if it's somebody who is going to threaten to take legal action, having your insurance there as a backup or as a resource can really kind of ease the situation for you and kind of help guide you through that whole situation. So a few other things. So I'm kind of talking about single member LLCs and sole proprietors kind of together. The other, I'm going to mention a few other pros and cons for them. So as a sole proprietor itself, without the LLC, as a sole prop, you don't have that legal protection. So as I was saying, if someone were to take legal action, they could just go after the business and not your personal assets. But if you are a sole prop, they technically can go after your personal assets and everything. So if that's something you're concerned about, then you might want to consider forming the separate entity. Um, but from a tax standpoint, as a sole proprietor and an LLC, uh, you are subject to self-employment tax on your profits. So that's something to consider uh, when deciding on the entities. So it is about a 15% tax on the profits. So that's on top of your regular income taxes. So for example, if you're making $20,000 for your business and you're in the 20% tax bracket, you pay your 20% on that, but on top of that, you have the 15.3% self-employment tax. So really, you are paying a much higher rate. So just keep that in mind. There are ways around it, which we'll touch upon, like using an S corporation, but the benefits come into using an S corp come in, once the entities or once the business is established a reasonable profit, roughly, when it gets towards like 60 or 80,000 in profits, that's kind of the threshold I talk to clients about when making the choice to form an S corporation comes into play. But I'll touch on that in a little bit. A few more things with sole proprietors and LLCs. Because you are subject to self-employment taxes, I mean, there are other deductions that you can take. You can use a SEP IRA, which has higher contribution limits than like your traditional IRA or a 401k. And the other advantage for SEP IRAs is that you can extend your tax return and extend the time that you have to actually make those contributions. And so you can actually contribute up to 25% of your profits into a SEP IRA. So, if your profits are $20,000, you can put up to $5,000 into the SEP IRA and get the deduction for that. So just keep that in mind. And then, like I was saying, if you extend your tax return, our tax returns are generally due, although they haven't been in the last 2 years. They're usually due in April. And so generally, if you make an IRA contribution, it needs to be made before April 15th. But the advantage of a SEP IRA is that if you extend your tax return, you can actually make that contribution. If you extend your tax return, you can actually make that contribution in October. So I have some clients where, their taxes are due in April, so it is kind of a cash heavy month. They may not necessarily have all the cash to make that IRA contribution. And so what we do is we extend the tax return. And so they know, okay, between now and October, I need to save up, like $10,000 to put into this SEP IRA account. And so what they do is they know, okay, well, every month I've got to save like, $1,200 or $2,000 a month to have before October, so that I can fund my IRA contribution. And so that's what they do. And so we wait and they save the money. And then in October, we file their tax return and they make the contribution. And then we file the tax return. And yeah, so, it is a good way to kind of help manage the cash flow when it comes to the IRAs, because, you do want to, most people reinvest their money back into the business, but then they forget about themselves. So yeah. The other question I remember I saw in the event was, how do you pay yourself? So if you are a sole proprietor or an LLC, because everything is already subject to the self-employment taxes, you don't actually pay yourself a salary. It's kind of weird, but you just take your money out and that's yours. Because basically everything all your profits are basically your income. So you don't necessarily have to formally pay a wage to yourself. You just take the money out. So and that's how it works for an LLC as well. And if you do have a partnership, that's a little bit different. But yeah, that's how it works for like a sole proprietor or a single member LLC. You just take the money out. So there is a question. It's kind of long, so I'll come back to that. So let me check my notes. So yes, so if there is more than one business owner in the LLC, you do have a partnership, so you are required to file a separate tax return that's its own tax return at the partnership level, and then also you end up with a K1, and then you report that on your personal taxes. So the other very popular entity type is a S corporation or a C corporation. So an S corporation is an entity if you have less than 100 owners, which most of you are from what I can tell inside the Facebook group, yeah, so it's a flow-through entity. So the profits of the company or the business gets taxed at your personal tax return level. So it's subject to your personal tax rates, as opposed to a C corporation, which has its own tax rate and its own tax filings. So an S corporation still has its own tax filings, but there's no actual tax for it. In most states, also are the same way. California has a 1.5% tax for S corporations, but for federal taxes, there's no federal income taxes for S corps. And so the difference between this and what we were talking about before with a sole proprietor or a single member LLC is that the S corp profits are not subject to self-employment taxes. And so, before, like we're saying, the $20,000 profits, you're subject to your personal income tax rates plus the 15% self-employment taxes. So in this case, as an S corporation, you have $20,000 profits. It flows through to your personal income tax return, and you're taxed at your personal tax rates, but not the 15%. So not the additional 15% for self-employment taxes. The major drawback with this, though, is because with an S corporation, you do need to pay yourself a salary. And so that opens things up to a whole different world, because now you're entering the payroll tax. You have to deal with payroll taxes. You have to deal with administering payroll. If you have if you decide to have an employee, then you have like workers' comp that you have to have, at least in California. And so when doing this, because now you have your separate tax filings, you have your payroll expenses, and also if something were to go wrong with payroll, you have to deal with that. So it's a big headache. And then lastly, because you do have to have what they call a reasonable salary. And so the idea is to keep your salary as low as possible, but it has to be reasonable. And then you can take distributions from the company. And so this part, it can get kind of confusing, but like generally speaking, like you pay yourself the salary. The salary is still subject to the same taxes as if you were a sole proprietor. But the thing is, if you have $20,000 profits, let's just say a $5,000 salary, or salary is reasonable, then you're only subjecting yourself to that $5,000 of that 15% tax. Then you can take distributions for the other 15,000 as a distributions, which is not taxed. So that's an example. I would say that that's a very bad ratio of reasonable salary to distributions, but that's just how it works. For an example, usually someone with $20,000, I would not say to go down the route of having an S corporation. Generally, I would say, when it's around like 60 to 80,000 at the bare minimum, because you do have the additional costs to administer payroll, additional tax filings. You complicate your taxes, your personal taxes get a little bit more complicated as well. So that's kind of the threshold that I have for that. The other advantage with S corps is, it does provide the same legal protection that LLCs do as well. So in that sense, they're very similar. Kind of a less popular entity right now are C corps for small businesses. Although if, let's just say one, like your spouse is a very high income earner and you are in a very high tax bracket, a C corporation might be worthwhile to consider because C corps get taxed at a lower rate. Well, will be taxed at a lower rate than your personal income tax rate. So I've had a client that's, they make very good money. They're in the highest tax bracket, and the wife wanted to start a business, and so we were considering, well, whether or not it would make sense for her to form a C corporation, have these profits taxed at the lower corporate tax rate. They didn't, in their case, they didn't necessarily need the money from the profits of the business, so she was able to just reinvest it into the business, and I guess when she wants to get, and then she'll take a salary for the money that she wants to get out of the company. So there are many factors to consider when choosing the business entity, especially with each individual situation, especially if you're married or have a partner. Those are factors that you have to take into consideration, as well as other investments, because sometimes, if someone's a heavy investor, they may have a tax year where income's going higher or lower, and you do need to take that stuff into consideration. Looking at my notes, I forgot to answer the question about someone who uses their house as their home kitchen as the place that they bake the cookies. And whether or not you can deduct that. So technically speaking, no. So the business use of home has a very clear term where it says that you must use the area exclusively for business. So, if you're using it also to cook your own dinners and stuff, then it's no longer exclusive. The other thing, there is kind of a way around it if you want to rent the space to yourself. So that's something that you can do. You end up, you're moving money from one pocket to another, but actually as rental income, it gets taxed. It's not subject to self-employment taxes, and then you just need to think of a fair wage to do it, and actually draw up a contract. I don't know if it's worth the headache, but you can. But if you do have storage, if you have space that you're using for storage, to store all the supplies, if you can allocate a corner of a room or a closet or the garage for the business equipment and materials, you can definitely deduct that. So a single member LLC, you would just measure out the square footage, and then you can take either the simplified option, which is you take $5 per square foot, and then you get that deduction. Or if it's a larger space and you're thinking, well, I do quite a bit, you can do it as a ratio of the whole house. So if you have 100 square feet used for the business of 1,000 square foot home, you can take 10% of the expenses for the house. But remember, in that case, you definitely want to make sure that it is an area used exclusively for the business, because that's kind of what the IRS looks at when, if they ever do question it. So a lot of times now with the simplified method, there's no questions asked. There's just, okay, you get $5 a square foot up to $600, and that's what you get to deduct. So, yeah. And then the other question that was inside the group was, converting your personal assets into a business asset. This all really depends as well. If it's, if you were already operating as a sole proprietor, you've decided to form